Make what thing bigger or smaller?
Big on the string.
I'm not sure what you mean.
Because it's very you know.
Well, the problem is that.
It's not the.
Oh, here we go. Okay, good. I was using this instead of this. Okay.
Okay, Mark. Mark, you're going. Anytime.
Okay. Now, if the casinos can make money by can make consistent money by taking an event that has a random outcome, or each individual event, each individual hand of blackjack has a random outcome in relationship to the last hand. We as traders can do the same thing, but we can only do it if we acquire the appropriate mindset. What I found the appropriate mindset to be is thinking that anything can happen. Not just thinking it, believing it. Believing that at any given moment, anything can happen. That every moment in the market is unique. Now, think about the word unique, about the definition of the word unique. Everyone probably understands or knows the definition of unique. Something not like anything else that ever existed. We understand the definition, but to actually believe that every moment is unique can be quite difficult because of the implications. The implications on our current set of beliefs, and as well as the way our minds are designed to think. Remember, our minds are designed to think in association, to link this moment, whatever's occurring right now in this moment, that's similar to something that's already in my brain. Something that's already in my brain as a memory is my past. And if every moment is truly unique, it means that in essence, my mind is not processing information in a way that's consistent with the way reality exists. Because what's going to happen is that, let's say for an example, I've got my edge, and my edge presents itself, and I execute my trades flawlessly for the first 3 trades. And they're all winners. And then the next occurrence of my edge comes up. My mind is designed to think in association, to take what's similar now in the environment. What's similar, because it can't be identical, although it may seem that way. But what's either similar or what we think of as identical, associate it with what's already in my mind, meaning I'm going to associate it with the past 3 trades. They've all been winners. It taps me into a nice, happy feeling. Possibly, again, like a state of euphoria. I might even cross that threshold. I have worked with traders where all it took was one winning trade to flip them into a state of euphoria. One, that's all. Just one winner, and they were flipped into a state of euphoria. And so the way my mind processes information is that I will automatically associate this now moment opportunity with my past, causing me to do what? Possibly make a trading error, right? I can make any number of errors. I can make a money management error. I might even jump the gun, get in too soon, because I think whatever's happening right now, I might miss out on it. Right? Or what if the last 3 trades were losers? Yeah, I probably won't take the trade. Why? Because my mind, the way it processed the information, caused me to enter into a state of mind that told me that this trade is a loser. The fact is, I, at a rational level anyway, do not know what's going to happen next. And the most important thing is I don't have to know to make money. I do not have to know what's going to happen next to make money as a trader. Does a casino have to know what's going to happen next on every single hand of blackjack to make money? Do they have to know what every number is going to come up next whenever the time they spin the roulette wheel? Or someone throws the dice and craps? No, they do not. And nor do we. We don't have to know what's going to happen next. And every time we get into a trade thinking that we do, for whatever reason, we have the potential to make a trading error and to create these huge drawdowns. Now, again, let's get back to the unique. Every moment is unique. How do we know for a fact that every moment in the environment is really unique? Not just the market, but in our everyday lives. How do we know, let's say, how can we establish that every moment is really unique? Is there any way to really establish it?
We change every moment, right?
Yeah, but I mean, so let's get down to a real fundamental level. How do we know that every moment's really unique? Well, yeah, but how does that make every moment unique? Time. And what's happening over time?
Changes.
But what causes change? Movement, right? Movement over time causes change, meaning that what we know, what we understand and know is that every atom and every molecule spinning around every atom is in constant motion. That's at the most fundamental level. So in essence, for a moment not to be unique, for some moment in time not to be unique, every molecule of every atom would have to be in the exact same position it was in some previous moment. I don't think that's possible. I don't know that it is or it isn't. I mean, I don't know for sure. I just don't think it's possible. And therefore, as a result, it makes it easier for me to believe that every moment's unique. And as a result of believing that every moment's unique, it makes it easier for me to counteract this automatic mechanism in my mind that causes me to process information in a way that tells me that I think I know what's going to happen next, when the reality is I might not. What I think is happening, what's really happening, could be there could be a vast difference between the two. A perfect example would be one in Trading in the Zone, where when I was many years ago, when I was writing The Disciplined Trader, it was like on a Saturday afternoon. I'd been writing all day, and I turned on the TV just to take a break, and it was late in the afternoon on a Saturday, and there was some locally produced program in Chicago called Gotcha Chicago. And what they did was just like, they did practical jokes on celebrities, but in this one segment, they hired a guy to go out on Michigan Avenue, and they stuffed his pockets full of cash and gave him a sign that said, "Free money today only." And his instructions were to give money to anybody who asked for it. That was his instructions. And so he went out on Michigan Avenue with this sign, and they had a film crew out there, hidden so that nobody could see what was happening. And first of all, he was shocked. You could tell he was shocked by the way that he was acting and the look on his face, because he thought that people would just come rushing to him asking for money. And they didn't. As a matter of fact, there were many people who were making a wide path around the guy. Now, if we make some assumptions here, one, that there were any number of people who passed him by that could read the sign. They actually, in fact, could read the sign, "Free money today only." And two, that money is very important to most people. As a matter of fact, maybe under other circumstances, crowds, people can get into a frenzied state of mind and act, act in very bizarre ways if they think money's free. So in essence, in some ways, he might have even been endangering himself and didn't even know it or think about it. So he was getting frustrated by the fact that nobody was asking him for money, and except for one guy. That's right. One guy came up to him and asked him for a quarter for a bus transfer. Okay? And I looked at this guy who's probably a panhandler, because there's a lot of panhandlers in downtown Chicago. So he got frustrated, and he walked up to some guy with a briefcase, typical guy's suit and briefcase, and said, "Sir, would you like some money?" And the guy said, "Not today." Really, not today. And he said, "Well, how many days does this happen?" And the guy just walked by him. Now, what does this example tell you about the nature of the way our minds have the potential to process information and the kind of interpretations that we can make? You can always tell what people believe based on their behavior. You can always extrapolate their behavior back to a belief, because it takes energy to express ourselves. Now think about this. There's any number of ways in any given moment that each of us can express ourselves, meaning interact with whatever environmental forces are attendant upon any particular situation. It takes energy to express ourselves, and we will express ourselves in some way that is consistent with what? With what we believe is true in the moment, right? Are you guys with me on this? So if I really got good at this, I could take anybody's outward behavior in relationship to the circumstances and really say, well, this is what they had to believe to behave this way. This is what they had to believe to behave this way. So what can we say about the people that walked by the sign? They didn't believe it. They were operating out of a belief that free money does not exist. And in most cases, it does not. In this particular day, it did. It was real. It was true. Anything can happen. Every moment is unique. And what about the people? So what we have here, and this is what's really critically important for you to understand. I need another one of these. What's the other one? Can't find that other blank one. Oh, here it is. Okay. Consistency is the result of a state of mind. So we have positive, we have negative. In other words, we have degrees of fear and degrees of confidence, okay? Confidence is positive energy, fear is negative energy. And what we want as traders, ideally, is to be in a confident state of mind. A confident, carefree state of mind, without the potential to define and interpret the up and down ticks in any particular painful way. So what we have in this situation with the free money is that every single belief that people were operating out of caused them to tap into a particular state of mind, from, let's say, from positive to negative, based on their interpretation. So we could say that the panhandler who asked for a quarter, got exactly what he asked for, and so therefore he was tapped into some degree of a positive state of mind. Right? Now, the people who were actually going out of their way to avoid him, what could we say about their state of mind? Their belief and their state of mind. Negative, some degree of fear. In other words, first of all, let's look at the interpretation. They see the sign clearly says free money today only. And so the first thing that happens is that their belief that free money doesn't exist acts as a counteracting force against the force of those words, saying, okay, that's not true. They deny the existence of the words, that's not true, and therefore, but this creates a conflict. And our minds don't like to be in a state of conflict or confusion. And so we have to reconcile the conflict in some way. In other words, there is evidence that says that my belief that free money doesn't exist is right here in the environment, where it creates this conflicting force. How do we resolve the conflict? We justify it in some way by saying, okay, since that's not true, this guy must be crazy. And if he's crazy, he might be dangerous. And therefore, as a result, I am going to take a wide berth around him. So as soon as I interpreted that information in a way that caused me to define him as dangerous, it tapped me into some degree of a negative state of mind, okay, because of my fear. Now, let's take a hypothetical situation. Let's say somebody saw the sign and says to themselves, oh, okay, what if? What if? He walks up to the guy and says, okay, give me 20 bucks. Guy pulls out $20 out of his pocket and gives it to him. What's going to happen now? No, not everyone else saw that. Okay, just say that he did it. And what's going to happen to the person that asked for the money? What? No, well, not that, he could. Yeah, it's possible.
It's that whole belief thing.
Yeah, in other words, yeah, something has to happen. In other words, his belief about that free money doesn't exist is going to change. What- Not necessarily. You never know. It's hard. I mean, every circumstance is really different when it comes to this. But the point that I'm making is that his belief that free money doesn't exist will change. They'll draw some of the energy out of it. Maybe not all of it. But this is in essence what we're going to have to do as traders to install those 5 fundamental truths that I had up a moment ago. We're going to have to change the way we think if you want to create consistent results. But I'm going to finish with the example. Hold on one second. Let me finish the example. So what ends up happening is that he's got the 20 bucks in his pocket, and what he's going to do is he's going to end up going back to the office or go home, and virtually everyone, because there's some really powerful implications here. Virtually everyone is going to say the exact same words to whoever it is they encounter, like their spouse or their friends or whatever. You won't believe what happened to me today. But 3 words, you won't believe. And you're right, they probably won't. Because their belief that free money doesn't exist will say, no, that's not true. I don't believe you. And like somebody said before, what could flip him in from, let's say he's walking around in a positive state of mind because he got free money, he got a nice pleasant surprise from the environment, didn't expect it. But what could cause that state of mind to go from positive all the way down to negative? What's that? No, the moment he thinks, or someone says to him, well, why didn't he ask for 100? Why didn't he ask for more?
Cancels out what you positive.
Yeah, and it flips, missed opportunity. Then flips from positive to negative, missed opportunity. Now see, here's the problem with these negative states of mind, and why these negative states of mind make it virtually impossible for us to create consistent results. It doesn't mean you won't create results. It doesn't mean you won't have winning trades. All I'm saying is that you will always have the potential to create these huge catastrophic drawdowns. And when I say catastrophic drawdowns, because somebody asked me that, like the question in Toronto 3 weeks ago or 4 weeks ago, what's a catastrophic drawdown? Well, I've worked with traders who were multimillionaires, and a catastrophic drawdown for them was, $1,000. They didn't have the tolerance to lose $1,000. So it's different for everybody. But the point that I'm making is that if we're trading with any degree of fear, what ends up happening is that fear as an energy has a very negative effect on our ability to stay objectively focused in the now moment opportunity flow. In other words, fear has the effect of narrowing our focus of attention onto the object of our fear so that we end up creating the very experience we're trying to avoid. So if I'm afraid of being wrong, I'll make myself wrong based on my interpretation of the information. If I'm afraid of losing money, I will cause myself to lose money based on my interpretation of the information. If I'm afraid of missing out, if I'm afraid of leaving money on the table, I will create these very circumstances that I'm trying to avoid. Go ahead.
Why can't we apply that same principle to greed?
To what?
Greed.
You're going to have to...
Fear. We do this for fear. Greed. We believe
Yeah.
to create something that makes us fearful. Why can't we have that for greed? So we have more greed and we can make more money and believe we make more money. Why is
Well, because the problem is because greed is the fear of there not being enough. The underlying fear behind greed is that there won't be enough, and I've got to get mine. And the I got to get mine part, causes us to do things. It causes us to do things that are going to be inappropriate in relationship to what the market's offering in that moment. It's
Greed is actually a form of fear.
Oh, absolutely. Yeah. What else could it be? The only reason why we're greedy is because we think we're not good. It's not going to be there for me. There isn't enough. Okay, well, look, I lost my train of thought here. I was going to get into something. What was I going to say? Oh, no, yeah, okay. No, I got it. Yeah, here's, see, so what we've got to do here, I just want to give you the example of how fear causes us to narrow our focus of attention. I'll give you a graphic example of what I'm talking about. If I've defined that as support, and I'm operating out of a fear of being wrong, typical trader, we've got 4 fears: being wrong, losing money, missing out, leaving money on the table. Those 4 fears are basically what's going to cause all those errors that we're talking about up there, okay? Now, if I'm operating out of a fear of being wrong, the first thing that's going to happen is that I will not want to predefine my risk, right? Therefore, I will gather whatever evidence is necessary for me to get into that trade to have convinced myself that it's going to work. The reality of the way the market works is that even though this is a pattern, and this pattern reproduces itself over and over and over again, I do not know the outcome of this particular trade, because I do not know if the buyers that came into the market here and supported that price and drove it back up, and the buyers that came into the market here and supported that price and drove it back up are going to be here in this moment. They may be out to lunch. Right? Okay, so as a trader, what do I really need to do? All I really need to do is define my risk and say, how much room have I, how much distance do I have to give the market to tell me that the possibility of this trade is so diminished that it's not worth staying in any longer? How much room have I got to give it? There's all kinds of methods that you can use to determine that, but the point is, I'm not going to go through that process if I'm afraid of being wrong. Because I might convince myself not to take the trade. And that's all based on the fact that I'm defining trading as a right or wrong endeavor, not as a probability game, not something that has random outcomes, which the reality is it has nothing to do with being right or wrong. Just like pulling the handle of a slot machine. You don't feel wrong when the tumblers don't come up. And the reason why is because you have a belief that you're operating out of that it's a random result. And so it doesn't connect it to your feelings of what it means to be wrong. So, what ends up happening? Let's say I get in this trade, and the market, does something like this. Okay? Now, the market gives us up and down ticks, right? At the most fundamental level, it gives us up and down ticks that form into patterns. If I'm afraid of being wrong, because it has the potential to tap me into the accumulated pain of every time I've been wrong in my life, what am I going to focus my attention on? The upticks or the downticks? The downticks? No, I'm afraid of being wrong. The market's giving me upticks and it's giving me downticks. In this case, it's giving me more downticks than upticks. Let's say on a 4-to-1 ratio. But that doesn't matter, because I'm going to take the upticks. I'm going to focus all my attention on the upticks. I'm going to place greater weight, greater significance on the meaning of the upticks in relationship to the downticks. In other words, my fear causes me to narrow my focus of attention in a way that makes the downticks invisible. In other words, we have automatic pain avoidance mechanisms in our mind. Everyone understands the nature of avoiding physical pain. You don't have to think about avoiding physical pain. In other words, this is a hot burner. I don't have to contemplate if I put my hand on it. I don't sit here and I don't weigh and judge or whatever, taking my hand off. It comes off automatically. Everyone understands that. What people typically don't understand is that the environment can offer information pain. Now, we all understand the nature of information pain in that context, but what we don't understand is the mechanism of how our minds will alter our perception of that information in a way that causes us not to have to confront it. And as traders, this is deadly. This mechanism is what causes all the pain. You're trying to avoid something that, in essence, you can avoid it, but it can't be avoided. And the reason why it's so difficult as traders is because in our everyday lives, we can lash out and we can control our environment or other people in ways, if we become effective at it, to cause them not to confront us with this information that we define as painful. And we can get really good at that. The problem is, you can't do anything to stop it, to stop the market from doing it, except control your perception. So, what ends up happening is that we place an inordinate amount of significance on the upticks, on whatever upticks that we might get, to the exclusion of the downticks, to the point where what? At some point, this guy's going to get out of this trade. What do you think the point is? We're talking energy dynamics here. Remember, all we have to do is look at someone's behavior in relationship to the external circumstances. We can tell what they believe. So, what's going on? When is he finally going to get out of this trade? Everyone in this room has experienced this, so you all really ought to know it. I'm sure there isn't one person in this room who hasn't done this.
And it reverses that.
What's that? Yeah, you're going to get out when it reverses up. However, that's true. However, what's the underlying dynamics? Is being wrong the only thing we're afraid of? No, we're also afraid of losing money, right? So we have two fears now. We have two competing fears, where in this case, in the back of our mind is our fear of losing money. But as the market keeps on going further and further down, this fear of losing money starts coming to the forefront of our consciousness until it gets to the point where, let's say, if this represents all the negative energy and a belief of what it means to be wrong, then when the fear of losing one more dollar is 1 degree greater than our fear of admitting that we're wrong, we will get out of the trade. You guys with me on this? When the fear of losing one more dollar is 1 degree greater than how much energy is in our fear of admitting we're wrong, is when we get out of that trade. And the interesting part about all this is that have I learned, or have you learned, the distinction? In other words, there is a pattern that the market can create called a trend. This is a pretty fundamental pattern, right? And under normal circumstances, I would be able to perceive and recognize when that pattern exists in the market. Interestingly enough, when I'm in this trade, I do not see this as a trend, do I? As a matter of fact, I don't see it till I get out and I hit myself on the head and say, why didn't I just go short? In other words, my fear of being wrong literally blinded me, created what's called perceptual blindness to the pattern or the opportunity that the market was giving me in that moment. Now, if we just take the opposite, look, instead of this trade being a loser, let's just say the market goes in the guy's favor. Okay? What's going to end up happening here? Is he going to focus on the upticks or the downticks? Downticks. Yeah, who hasn't been in a winning trade where the market came back and took the money, right? So you're operating out of a fear of leaving money on the table? And that's exactly what's going to happen. Because every downtick, that fear that the market is going to take money away will well up, causing us to think that we know what's going to happen next, not recognize, let's say, that we're in an uptrending market and get out of that trade here instead of somewhere up here. And therefore, what ends up happening, of course, we fit the profile of the typical trader, where we let our losses run and cut our profits short. And that's all because of the dynamics of the way fear causes us to narrow our focus of attention on the object of our fear, so that we end up creating the very experiences we're trying to avoid. How much more time have I got, by the way? 30 minutes, because I want to make sure that we... So what we have to do, if we want to create consistency, we have to get to the point where we no longer have any potential to define and interpret what is, in essence, neutrally charged information, or with information without a charge, in any kind of negative way. How are we going to do that?
Is that a question?
Yeah, I'm asking you. How are we going to do it?
That's what
Not a plan.
you.
What's that?
That's what we want you to tell us.
Redefining your risk.
What?
Redefining your risk.
Well, that doesn't, predefining your risk, I mean, accepting your risk implies, predefining and accepting your risk implies that it's completely reconciled, that there's no other conflicting energy inside of you that would argue otherwise. But the point is that how am I going to get to the point where I have access? Because really I'm going to define objectivity. I'm going to define what I want is I want 100% access to everything I've learned about the nature of the market in any given moment. Remember, I just said that my fear of being wrong caused me not to be able to perceive that as a trend. That's a distinction about the nature of the market. That distinction offers me opportunities to do something. That's part of the opportunity flow in any given moment, telling me what the market's potential is to move in any particular direction. If you look at at just the concept of objectivity, is there such a thing as an objective reality? You could say that the only way that two people could actually be experiencing the very same thing in any given moment is if you had simultaneous awareness of everything going on at once. Now think about what I just said. Simultaneous awareness of every distinction that the environment, every possible way that the environment can characteristically express itself, you can perceive. And if I can perceive every possible way, and you can perceive every possible way, you and I are sharing a reality. Up to that point, anything less than that, and we're in our own little world. And there will be times in which we may be sharing a reality with another person, but for the most part, based on our interpretation of the information, it's unique to us. Now, has anybody in this room learned to make every possible distinction in terms of the way the market can express itself? This group dynamics, this group behavior? So in other words, if you shake your head no and you think that, okay, I haven't learned to make every possible distinction in the market's behavior, it means that at any given moment, there's things going on that are invisible to me, right? Because I can't perceive what I don't know. Just like the first time you looked at a price chart, what did you see? You saw lines that had no meaning. You couldn't make any distinction. That's right, you couldn't make any distinction in the nature of those lines, right? Here, give you a good example. Real quick. Here we go. Look at a chart like this. What do you see? You see a bunch of lines, right? Okay. Where's the other one? Oh, here we go. Same chart. Well, just take it away. Same chart. And all those measurements are almost exact. Really, virtually exact. I didn't fudge on anything there. That's symmetry, those are patterns, okay? But when we first saw these charts, okay, what did we see? Our minds could not make any distinctions at all that represented opportunities. Now, since all of us have learned to read charts to some extent or another, if I can magically reproduce the first chart you've ever looked at and put it before you right now, would you see opportunities in that chart that were completely invisible to you the first time you looked at it? Okay. Now, what I'm saying is that all of us have our own objective reality. Meaning that if I've learned to make, let's say, 30% of all the possible distinctions in the market's behavior, in any given moment, I want to have conscious access to all 30%. To whatever degree I'm operating out of fear will diminish that percentage. You with me on this? Every degree I'm operating out of fear starts to diminish the percentage of what I can perceive of what I've learned about what's available, to the point where it can almost get to zero. So if I'm going to create consistent results, I have to find a way to trade in a carefree state of mind without the potential to define and interpret market information as painful. How am I going to do that?
You have to release control, that you have any control over it.
Yeah, how are you going to do that? Ignore what? Ignore outcomes? We're going to have to step into an active process of changing the way we think. Step into an active process of changing the way that we think. To simply think like the casinos think. And in essence, this is what I'm talking about. Because every single one of these beliefs, that every moment is unique, and edge is nothing more than an indication of a higher probability of one thing happening over another. There's a random distribution between wins and losses in any given set of variables that define an edge, and you don't need to know what's going to happen next to make money. Every single one of those statements represent a concept about the nature of the way things work. This is the truth from the market's perspective. The closer that our minds are aligned to this truth, the less fear that we have the potential to operate out of, or the less potential we have to define these up and down ticks in any kind of painful way. Are you guys with me on this? So how do I get those in my brain unconflicted? How do I do that?
Probabilities and statistics.
Probabilities and statistics?
You believe in that?
Well,
Has to be part of your subconscious.
Well, you don't necessarily have to be. I mean, it'll drop down to a subconscious level after a certain point, but it doesn't. No, how to? In other words, you have to learn how to change your beliefs. That's basically what I'm getting at. You have to learn how to think, change the way that you think about things.
So then you have to know how you come up with believing something in the first place.
Yeah, exactly. So basically, I mean, we don't have that much time here. I mean, I don't even have that much time left. I mean, this is something that normally takes me a good 2.5 days to get through. I mean, 2.5 days of really intense stuff. But I'm gonna tell you how to do it. And if at least if you go to Trading in the Zone, you can reinforce it there. You could also get I've also got tapes, or you can even come to one of my workshops, which I'm going to be doing one in August in Scottsdale. But if you can't do any of that, at least know that there is a way to do this, and that's simply to set up a trading regimen. Use your trading to acquire skills instead of trading to make money. The money will be a byproduct of the level of skills that you've acquired. And to set up a trading regimen that is specifically designed to learn to believe those 5 fundamental truths. I'm going to say it again. To set up a trading regimen that is specifically designed to do one thing and one thing only, and everything else is not irrelevant but of secondary importance. To believe those at a core level of your trading identity in an unconflicted way. To believe those truths. So how would I do that? It's not that hard, really. I mean, I'm saying it's not that hard to set it up. You might find it hard to do. Might find it very hard to do. Anyway, the way I what's that? Yeah, the way I suggest to do it is to create a mechanical system. Now, is to take, when I say a mechanical set of variables, I mean exactly that. Where your entry signals have to be precise. Where there's absolutely no subjectivity whatsoever as to whether or not this signal or this particular edge is present or not. No subjectivity. And your exits have to be precise. As a matter of fact, probably the best way to do this exercise, especially if you guys if you trade electronically and you do it and you trade the E-mini S&Ps or the NASDAQ, is to set up a trading exercise in which you go like 2 for 2 in the S&P, risk 2 to make 2, or 5 for 5 in the NASDAQ. Those are pretty easy parameters to work with. In other words, whatever comes first. So you don't have to make a judgment about where to take profits or where to take losses, for that matter. And also what I suggest, I even set this up in a way where I just use a simple crossing stochastics on a 3-minute chart, like an 11-period stochastics on a 3-minute chart. You can either do it 2 ways. You can either take every signal because you might get anywhere from 25 to 30 signals a day, or you can wait for divergence between stochastics and price. When there's a divergence, you just take those right there. So for an example, if you have if the market's going lower and stochastics crosses and you get a little bit of a rally, and then the market makes a lower low, but on the stochastics it makes a higher low, that's price divergence when you connect the lows, then just take that one right there. And what I do in these circumstances, just to set up the exercise, is that I wait for a hard cross. Wait for a hard cross in the stochastics, meaning that when the market's, like on that bar where it's about to cross, the lines can cross and come back depending on whether the market's going up or down. And on the open of the next bar, it'll make a hard cross, meaning that they won't cross again until the actual numbers cause it to cross. So you actually go in on the market on the open of the next bar. So that way it's precise. There's just, you got to click as soon as they open. Now, what's the point of this exercise? The point is this. You guys clear about that? Okay. It's about the cleanest one I've got here. I only brought 2 of these. Here's what you want to do. You want to set this up in 20 trade sample sizes, between 20 and 30. No matter what particular variables you might use to define an edge, it doesn't matter. Really, the best thing to do is come up with your own set of variables. How good the variables are and how well they work is of secondary importance. If you just paid for commissions with this particular exercise, you would be doing well. If you just paid for commissions. The point is this, is that instead of saying, I'm going to take the next trade, like what most people do, you're going to say, I'm going to take the next 20 trades. You're trading in 20 to 30 trade sample sizes. Meaning what you want is you want a sample size of trade, just like flipping the coin. You want a sample size of trades that's large enough to adequately test your variables so that at the end of the sample size you can say, okay, my results are satisfying, therefore I'm going to take another 20 trades. Or you can say my results are unsatisfying and I'm going to tweak my variables. But you cannot tweak your variables in the middle of a sample size. That is absolutely forbidden for this exercise. And in essence what you're saying is that, okay, I'm going to take the next 20 trades. 20. And what you want to do, in essence what you're going to do with these next 20 trades is you're going to learn, you're going to be training your mind, you're going to be convincing yourself that you don't know what's going to happen next. And that you don't need to know to make money, because you don't know the distribution between wins and losses. Even if I gave you a system that in the past produced 70% winning trades, I still couldn't tell you. If I'm going to say I'm going to take the next 10 trades, I can't tell you which 7 are going to be winners and which 3 are going to be losers. I don't know. There's no way I could know. So that in essence, what that requires me to do as a trader, if my objective is to become consistent, is that I have to take every single trade. And I have to do it flawlessly, meaning I have to get to the point where I have flawless execution. And that's something you have to recognize as traders anyway. Analysis does not make you money. Only actual executing a trade can make you money. And so what I want to do is I want to get into these circumstances. I want to get into these circumstances where, let's say, this was a winner, and this was a winner, and this was a loser, this was a loser, and this was a loser. Now I'm on this. Now I'm confronted with this sixth trade, and my mind, everything in my mind is telling me, no, that's a loser. I can't take that one. Just do the best you can. Take it, don't take it. But the point is that when you can do, and what I'm saying is that not to avoid these circumstances, when you can step through all these conflicting thoughts, when you can actually take the trade anyway, and that one turns out to be a winner, what you're doing is you're automatically drawing energy out of anything else that's inside your environment that would argue against doing exactly what you need to do when you need to do it. Every time you confront one of these situations and do the appropriate thing, step into it, confront it, and do it anyway. The point is that you will know when you have integrated those 5 fundamental beliefs in your mental environment effectively, when you can do one of these 20 trade sample sizes flawlessly without any conflicting or competing thoughts. You will be a trader, guaranteed. You will be a trader. So if you're going to set this up, set it up in a way that makes it easy on yourself. You don't have to be trading a large amount. You don't have to be trading, you want to do the S&Ps, the NASDAQ, just trade one contract. You don't even have to trade multiple contracts, just trade one. If you trade stocks, trade 10 shares. Doesn't matter. It really doesn't. This is not about making money. It's about creating skills. Consciously stepping into a process of creating skills. This isn't any different if you were a golfer, if you're into tennis, if you're in any other kind of endeavor that required certain skills. The difference is the skills are mental. You guys have any questions?
I just have one comment to make. I mean, the reason why we don't think logically is because human brain is supposed to think in risk and passion because of evolution. I know kind of personal psychology, but the reason is we don't apply the logic outcomes because apparently we were cavemen. We didn't have the luxury of being retrospective, so we took whatever and we didn't go back and practice. The survival was the key.
Huh. I mean, yeah, when you,
Is that the
yeah.
reason why?
Well, you think about it this way. I mean, if our beliefs were a 100% reflection of the way things existed. Now think about what I'm going to say right now. If our beliefs, if there was a 100% correspondence between what I believed and the way reality existed, what would that imply? That would imply I'd always have my expectations fulfilled. I'd be in a constant state of satisfaction. You guys with me on this? Because what is an expectation? An expectation is simply my mental representation of what the next moment or the next, a minute from now, 5 minutes or whatever, is going to look like in the environment. If the external environment shows up in a way that's consistent with what I expect, then I'm going to be in a state of satisfaction, right? To whatever degree it doesn't show up in a way that I expect, I will be in some degree of emotional pain. That is a universal characteristic of human nature. Everyone wants their expectations fulfilled. But the point is that if like I said, I'll say again, if our beliefs were a 100% reflection of the way reality existed from its perspective, from the environment's perspective, then we would be in a constant state of satisfaction. We'd always be getting what we wanted. Which implies that if we are not, then something's got to change. Now, in a social environment, if we've learned how to exercise control over people and the environment, we'll make the environment look like the way we want it to. There's always consequences to that. There will be, because nobody likes to have to behave in a way that's inconsistent with what they believe. And if there was harmony between my belief and their belief, I wouldn't have to do anything in the first place, correct? The problem is we can't exercise that kind of control over the market. The only thing we can exercise control over is our own beliefs. And to create them in a way that's consistent with the way the market exists. The market exists in a probabilistic way. It's that simple. If our beliefs that we're operating out of are not consistent with that, then we are not going to create consistent results. It's that simple. We'll create random results. And we'll have a lot of fun. And we'll have winning streaks and we'll have winning trades. The problem is we'll always be susceptible to the catastrophic drawdowns. And they take their toll. Go ahead.
Mark, in your experience, it sounds like we got these perceptual filters. That this exercise eventually takes those things away.
Correct.
We get in harmony with the market.
Correct.
Has it been your experience, or do you think it's to the point that you just get to the point where you just know? I mean, you're so unbiased by anything that what to do next is just obvious?
You mean, in other words, you're operating out of a sense of, like an intuitive sense? Yeah, exactly. You're in the zone. In other words, there's complete harmony between you and your mind, your state of mind, and what the market is offering you in any given moment.
So the market's never trying to hide anything from
No.
you, it's just we put the blind.
That's right. Exactly.
So
Go ahead.
is that obvious then?
Is that obvious? What do you mean, is that obvious?
Isn't that obvious?
It is obvious when you're in that state of mind. That'll be obvious. And when you start thinking about it is when you'll pop yourself right out of it. So go ahead.
I want to go back to your fishing deal.
Yeah.
Doing a lot of fishing. Sometimes I let Rodney catch fish, which I put the rod in the rod hole, and I end up catching more fish that way than I do trying to actually fish. Which brings me to the mechanics of this. If we set up precise entry points, which there's a couple ways of doing that with you mechanically get in, or you have stop loss stops to get in. Can you set this up mechanically and let it go on your? I think I read you on precise entry. I understand that.
It has to be, precise.
But on your precise exit, that is.
You're better off setting it up where everything's precise. What you don't want is to get yourself into a situation where you can't make a distinction between what's going on in you and what's going on in the market. In other words, if you set everything up, if you set this regimen up in a way so that you know that it's you that's having the conflicting thoughts, it's not some let's say some judgment that you have to make so that you can rationalize away your mistake.
I've done that with stops on stuff. I'm emotionally attached. If it hits a client, that's okay. I've already done that. So on my trade planning for the trade, then I can actually pre-plan to what I'm gonna take the profit, pre-plan my loss, put that in there and walk away.
That's right. Yeah, if you want to walk away, the best thing to do, look, if you're already evolved enough where you don't have these kind of problems that I'm talking about, you don't have to do it at all. All I'm saying is that, if you have the potential to define and interpret market information in any kind of a painful way, then for whatever reason, you probably have to do this exercise. You haven't acquired all the skills that are necessary. Instead of walking away, the best thing to do is actually sit there and watch it, meaning confront whatever it is that needs to be done and do it in that moment, being aware of all the conflicting thoughts. In other words, I'll give you another example. There's a trader I worked with many years ago who owned a couple of construction companies in Texas. He was in his 50s. He was trading bonds. He was losing his ass. He thought, okay, I'm going to go up to Chicago and show these guys something, right? So he bought a seat at the Board of Trade, went into the bond pit, and just got annihilated. So he was having one of his bad days, and someone suggested he come to me for some coaching. And so one of the things that I realized, of course, that he really couldn't even define an edge. And at the time, I was using point and figure analysis, and so I showed him how to define support and resistance within about a 6 or 8 tick point range in the bonds. And so we did this for about 2 weeks, and so it was time for him to go down to the floor and implement what it is that we did. And his instructions were very precise. In other words, if the market was in between, support and resistance, that if it came down to support, he was to execute his trade at a specific price. He was only supposed to risk 3 ticks, which is just about a little less than $100. 3 ticks, and if go 3 ticks against him, he had to get out. If not, and it went in his favor, he waited until it reached resistance. He took his profit and reversed and with the same stop. So the day that he went down there, the market was perfect because it was right in between. It came down to support. As it's coming down, he thinks it's not going to get to his price. He ends up getting in early, like 2 ticks early. It gets to his price where his original entry price in the first place. He thinks it's going to keep on going, and he blows out of the trade for a 2-tick loss. The market reverses, goes back up, does the exact same thing at the top, just completely screwed the whole thing up, right? Now all he had to do was risk $100 in each case. He couldn't do it. He literally could not do it. He did the same thing the second day, the same thing the third day, so he stopped calling me because he didn't want, this is the kind of guy, he barks out orders to people, he expects them to do it. He thought he could go down to the floor and do the same thing. He found he didn't have any capacity to do it whatsoever. So in the meantime, he's down there trading for 2 or 3 weeks, and he's getting better and better at defining support and resistance. So the interesting part about what ended up happening is that he would end up waiting till the market hit his price and get in, but he was so afraid that the market was going to take his money away, he'd end up getting out of the trade for like a 1 or 2 tick profit. Now what was particularly exasperating for him was that many of these trades, as he went back and looked at his entries, there were many times he had bought the low of the day or sold the high of the day and only ended up with 1 or 2 ticks. So this was like really bothering him. So I didn't hear from him for about 3 weeks. He called me up, explained to me what was happening, and his solution to the problem. His solution to the problem was to go ahead and up his size up to about 20 or 25 contracts. So, hey, makes sense, right? The problem with upping his size. So see, instead of learning how to hold on to his trades, okay, he's going to up his size and get the money, right? Well, the problem with upping your size is that you go from a 1-lot trader in the bond pit to a 20-lot trader. You're dealing with a completely different set of guys. There's all kinds of problems with that. Anyway, I knew he was gonna really, it was a disaster, and I knew it. I didn't say anything to him. I thought, hey, just let him. He's going to do it anyway. What difference does it make? So he did. He called me up. He lost all the money he'd made in the last 3 weeks, plus a bunch more. He said, okay, here's the key. I am ready to do anything. Okay? He was ready to do anything. And he was. He sincerely was. So I gave him an exercise, a real simple exercise. Very similar to what I just gave you guys. And this exercise worked great for him. He had to do the exact same thing as before. The only difference is that when he got that trade on, he had to put his hands in his pocket, turn and look at the clock on the wall and be in agony for as long as he could. He had to put his hands in his pocket and look at the clock, and here were the parameters. The market either stopped him out, or he had to stay in it for 20 minutes, whatever came first, or it reached his objective. 20 minutes, And the longer, and the first couple of times he, I don't remember, but it's probably only a minute or two that he could stay in the trade. But he worked his way. He was very diligent about it. He worked his way up to the point where he could turn around and look at the clock and face each agonizing second until it wasn't agonizing anymore. And then he went on to make quite a bit of money trading. So the point is of that story is that don't walk away from it. If there's conflicts, stay with them. In other words, be with it. Embrace it.
That's so fun.
What?
That's a lot of work.
Yeah, well, hey, depends on how bad you want the skills. Go ahead.
I have read somewhere, quite a number of places actually, where someone has a trading system.
Oh, what? A trading system?
That is so good. Like, never had a single loss trades in 30 trades. All right. Is this person behaving from your philosophy, or he has an edge that we don't know about? And what would that?
That would be hard for me to answer. It is very possible for someone to have winning streaks of 30 or 40 trades in a row. That's not that unusual. It really isn't. I know it may seem like it, but it really isn't.
But it's not a function of understanding the dynamics of the market.
It's a function of both. What it is that when you've got the appropriate mindset, that's when you can utilize your technical abilities to their fullest potential. Okay? It isn't the other way around. Learning about the market's not going to give you this mindset, guys. It just isn't. If you think learning about technical analysis is going to give you the mindset we're talking about, you are down. You are headed. You're either on the path or headed down the path of ultimate exasperation. It isn't going to work. Okay.
If this is about human reaction, then what is better? Is it better to just buy a system that exists, which many have tremendous track records, and leave it with the broker and let him trade that amount of money? Or is it better to trade that same amount of dollars if the human factors?
I can't answer what you think is better, because it has to be within the context of what you're trying to accomplish. Still you have to say, what are you trying to accomplish? If what you're trying to accomplish is just to acquire profits and you don't want to trade, then give it to somebody else to do. The question really answers itself. But just put it within the context of what you're trying to accomplish. Put everything within the context of what you're trying to accomplish. What's your objective?
To make more money.
Then do it whatever way is satisfying to you. Do it in a way that's most satisfying to you, whatever that is. And only you can determine that. The man says I got 3 minutes. Anybody else? If not, we can end 3 minutes early. I can take a break. Are we all done? Okay. Let's go.